Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the CBOE Market Volatility Index, ticker symbol VIX. This is a special report, as you will soon see, but I'm starting off with the VIX to show you how the forecast lines worked out from last week. And as you can see here, I said we would most likely go down to test the support level down here and then bounce with the end of that line right there at 2242 as the target. That target was set because of this gap, and I said that 100% of the time gaps fill on the VIX, and then 100% of the time, guess what? After the gap fills, it reverses. And right here on Wednesday, we filled that gap with this long shooting star right there. It's a shooting star candle, very bearish, and then headed right back down. So that worked out perfectly. Now that we have that out of the way, let's clear the lines and let's see what happens next week, or what is most likely to happen next week. We have a support level here again that is most likely going to maintain. And the reason I think we're going to go a little bit lower on the VIX is because today, as I magnify that, you'll see that we have a cross of that momentum line. That's a zero line on the CCI. So the momentum will most likely continue for 2 to 4 days here, and then I believe we're going to bounce and start to move back up with a higher low than what we've seen in previous lows. So what does that mean for the SPY? Well, for the most part, the VIX is inversely related to the S&P. And as you can see right here, as I magnify this, we hit the moving average. That's a 20-period moving average. Came very close to my target, which is the gap fill target right there. And while we didn't hit it, we missed it by pennies, I still think that we're going to move up and then start to pull back because of the gap below the market. Now let me draw these lines exactly so they stay in place for you. First, let me magnify that again. This gap, which, by the way, filled precisely to the penny. Now, we have a resistance up at the top right here that just may be tested because the oscillators are starting to move up. I think we could go a little bit higher on the spiders. Why? Because I think the VIX could go a little bit lower. And then what do we have? Down below, we have that open gap. So ultimately, I think we're going to start to pull back, and we'll most likely see a lower high. Now, keep that in mind as I get to my big announcement towards the end of this presentation. So that's for the spiders. We take a look at the diamonds. We left the lines on the chart again, said that we would most likely move up to fill this gap. We didn't quite get there, but that's not filled yet. That's still open gap, and I think we could still do that. Again, look at the oscillators down below. We have the CCI actually starting to move up over that momentum line. We have the stochastic starting to move up. So I think we're going to move up, fill that gap, and then we're going to have to watch out below right there. I do believe we're going to wind up by the end of next week back down below that 20-period moving average. Remember, there's only 5 more trading days left in the month of May, and that brings me to the monthly chart on the Qs. Take a look at this. If we look at the monthly chart, we see wide divergences from that moving average. We see the beginning stages of what could be a bearish engulfing pattern. Remember, we have 5 more days left in this month. Memorial Day Monday, the markets will be closed, so we only have 5 more days left. And as I zoom in here, you'll see what my forecast lines look like for the Qs. Came very, very close, said we would most likely move up. I still think we have some upside potential there, but I'm going to keep that as my target, but extend on that to the downside. Why? Again, because there's a gap below the market, and I think that will ultimately fill. All right, so that's for the Qs. If we take a look at IWM, which is the Russell 2000, again, target almost hit. I think that will too be tested. I'm going to leave that right in place. Again, look as I magnify the CCI. That's a momentum indicator that's telling us that it's crossing over the zero line. 2 to 4 days of upside potential is in store for us there, according to history. You'll see back here when it crossed above, we had 2 to 4 days of upside. I think we're going to duplicate that. End line target for IWM, 227.75. And then once we get up there, we'll start to see the pivot point. Now, this brings me to the announcement that I want to make. This is more of a repeat of what I just got off a conference call with the Market Rebellion folks. We had a great session there in what was called the cocktail hour, and we had some great debate on where we think the market's going to go. But before I get into that, let me just show you some things here that you need to pay very close attention to. This is the Goldman Sachs Commodity Index as it compares to the SPX. This is a ratio. Now, pay very close attention here. This is where we're going to go into a little overtime, but it's worth it. Back here in 1970, I was a kid. I could care less about what was going on in the world except, my friends and what was happening in school. But by the time I became old enough to drive a car, this is when the first economic crisis of my life where I felt the pain. That's when we had to wait in line for even odd days to get gas. But my point is, when this ratio drops to this level here and beyond, it becomes very bearish for the market. Now let's move fast forward. 1987, you see we reached a low very close to 3 on that scale, and then we started to pivot up. This was my big lesson in 1987. That's where I lost my first $1 million in the silver market. Never repeated that again, that's for sure, because I learned from my mistakes. Now, let's fast forward to 1999. Right here, I was working as an active trading consultant with Charles Schwab, and I am on record on recorded lines with attorneys by my side calling the market bubble top. And that was in 1999. It took a full 4 months before that came to fruition when this ratio started to turn up. Remember, it's when the pivot point forms that the market starts to roll over. Again, look at the cycle. Every 15 to 20 years, we see lows here. Look, 1970 to 1985. To 2000, right? To 2015, and now into the 20th year separation right here from the bubble top in 2000. Now let's keep going because this is extremely important as we follow suit. Right here in 2008, again, I was on record for calling the top, and 2007. What was happening? Take a look at the calendar down below. In 2008 and at the end of 2007, this ratio started to turn up. Commodity prices started moving higher, equity markets started moving lower, and these numbers came in line. Where does that leave us now? Right here. Folks, take a look at this. 0.5967, that's the lowest reading in history. Hence the reason why I'm calling a top here. And it leads me to the point where I have to first tell you I am not an alarmist. I've been pounding the table about risk management for many, many months. Got a lot of flack for that over this time. But I'm telling you, now is the time to be protecting your accounts, to be embracing risk management strategies. Now that we have a pivot point starting to form, take a look at what's happening with regard to history, how it compares to history. What does it look like now when we compare this to the crash of 1929? If you'd like, hit the pause button. You can read some of my notes off to the left right there, but take a look. This is a side-by-side comparison of the chart and the way it looked in 1929 as it compares to the current chart here in 2021. Now, before we get into this, take this into consideration. This sell-off last year and the pandemic sell-off. If this had not occurred, we have almost the identical price pattern in the 7 years leading up to this top as we did in 1929. Look, back here, we had a breach of the moving average. Here we had a breach of the moving average. See that? Follow along. Then we had a rally over the moving average with a high here. Then we had a rally right up into this high, then a pullback, bounce off the moving average, a new high, bounce off the moving average, new high, pull back to the moving average, pull back to the moving average, and then a parabolic move higher with a wide divergence from the moving average as we see here. Now this chart is taken from a Thinkorswim platform. And for those of you that have that platform, you can switch the Dow Jones Industrial Average to a monthly chart and it will bring you all the way back to 1900. And you can expand this to see for yourself. Now, obviously, we didn't have candle charts back then, but when they plug in the information that we have from the market over the years, they plotted on a candle chart just like this. Notice again the divergence. And right here, remember, there were no candle charts back then, but today we can see that was a bearish engulfing pattern right there. Right here, look, they call this the kiss of death when it fails to get back on trend. That is a bearish harami. Today, and then this month, we have a shooting star, second most bearish candle that we have. Notice, shooting star, the month before the pandemic sell-off. Notice, a bearish engulfing pattern. Notice, a bearish harami before these sell-offs back here. Technical analysis is the best you're going to get as a forecasting tool, and I'm asking everyone to pay very close attention. Why? Because this is my forecast. I'm not calling a market high, I'm calling a market top. What's the difference? We could pull back, we could bounce, but I think we're going to start to see lower lows as we form this downturn. The rollover is already beginning, as we saw in the Russell 2000 in this chart. Notice how we're having lower highs followed by lower lows here. For the members that are following my alert service, what I'm doing is I'm putting a blanket alert that if the Russell 2000 closes below 210, which is going to be this key support level right here, we're getting out of any long call positions or anything that's a positive delta, and we're going all bearish at that particular point. Now, here's the key. You have time. No need to panic. Again, this is not me sounding the alarm. I'm trying to wake people up to the fact that we're not looking at another major bull market down the road. There's a lot of differences of opinion with regard to, okay, what if the Fed puts more money into the market? Okay, they already have a lot of money in the market, hence the reason why we have inflation. Mortgage companies are having a hard time loaning money. As you may see from the real estate market, people are coming in with large sums of cash, bidding up past the listing prices of some of these houses, and the banks are having a hard time loaning the money. And we're going to have a crunch with that. We're going to have a money supply that's out of control. And we have prices that are out of control with the Fed that is anchored in to holding rates as is. If the Fed doesn't raise rates to cut this inflation, this is only going to result in a lower market with the silver market possibly going higher. We see what's happening with the Bitcoin market and the crypto market. We're seeing major sell-offs because of people moving out. That's nothing compared to what I think could happen in the overall markets right here. So again, stay calm. We have plenty of time, because if we're looking at this being a market top, and I look at this with a monthly chart, month by month, we still have time before the rollover is complete. Again, we have 5 trading days left in the month of May. This is a hanging man, also combined with a bearish engulfing pattern. I don't think it's going to drop all the way down to the moving average in 1 month. Do not think that's going to happen. So if you prepare, move to the sidelines on some of your positions, create cash for yourself, which creates buying opportunity on the next bounce, then you'll be in better shape than you might be now with long positions held right at the high. All right, if you have no cash available to participate in a down market, then you're going to be stuck at the high, only wishing you had sold at the very top. So that's it for me. Have a great week, and we'll talk to you soon. So long.